Welcome back to Talk Tickers. Today we're doing a deep dive into the Q1 2025 earnings call from Hesai Group.
Right. This is a fascinating one. A LiDAR company really pushing things forward in a market that's just, well, it's moving incredibly fast.
Definitely. And our goal here is to really break down the key financials, pull out those critical insights from what management said, and basically help you understand what truly matters from that call.
Exactly. Cut through the noise, get to the core.
So let's jump right in. Quick snapshot. Q1 2025. What are the headline numbers that, really jump out?
Okay, top line first. Total revenue came in at RMB 525.3 million. That translates to about US $72.4 million.
Which is a pretty big jump year over year.
Huge. 46% increase year over year. That's the big number there.
And you don't get that kind of revenue growth without moving serious volume. What were the shipment numbers?
That's the real story behind the revenue, I think. Total shipments were nearly 200,000 units.
Nearly 200,000.
Yeah, and get this, that's more than triple the volume they did in Q1 of 2024.
Triple. Wow. And that's not a one-off trend, is it?
No, exactly. This is actually the third consecutive quarter where they've seen over 150% year-over-year growth in shipments.
Okay, so the scaling is just phenomenal.
It really is. It's fundamentally changing the shape of their business.
All right, massive top line, huge shipment growth. What about the bottom line? Still a net loss reported?
Yeah, still a loss technically. RMB 70.5 million, which is about US $9.74 million.
I sense a but coming.
But look at the change. That loss is down 84% compared to Q1 last year.
84% reduction.
Yeah. That tells you a lot about cost control, about operating leverage starting to kick in.
Okay, that's significant progress then.
Absolutely. And tied right into that, they actually achieved non-GAAP profitability for the quarter.
Ah, okay. That's a key milestone investors definitely watch for.
For sure. And gross margin held up really well too, came in at a healthy 42%.
42%, solid. All right, that's the quick picture. Let's dig a bit deeper now. How is management positioning the company? What's driving this operational momentum?
Well, the CEO really emphasized strong momentum in both their main areas. ADS, that's Advanced Driver Assistance Systems, and also Robotics.
Okay.
And they were pretty clear linking that huge shipment growth directly to the revenue jump. And importantly, crediting their execution and cost control for slashing that net loss so dramatically.
And they're getting some external validation on their market position too, right? Those EO intelligence rankings.
Yeah, exactly. EO Intelligence, based on their 2024 analysis, ranked Hesai as the #1 global leader in automotive LiDAR market share.
#1 overall.
Yep. 33% share of the total automotive market. They also called them out as #1 in global passenger car LiDAR specifically, with 26% share.
And Robotaxis. I remember that share being even higher.
Dominant. A massive 61% share in the global Robotaxi market. And, these aren't just abstract numbers. They reflect their actual pace of innovation and their proven ability to scale up production faster than others.
Let's focus on that AD segment for a minute, because that seems like a huge engine right now. The Shanghai Auto Show seemed to really highlight LiDAR's growing presence.
It really did. It was kind of a showcase for how mainstream LiDAR is becoming. You had over 100 vehicle models there with LiDAR tech.
Wow.
And Hesai's technology was integrated into models from 12 different OEMs at the show.
Okay.
But here's the kicker. Among the new 2025 production models being shown off, Hesai had the highest number of integrations.
So this isn't just future tech anymore, it's hitting the road now.
Exactly. It shows LiDAR is becoming, well, almost a must-have feature for safety and for those advanced driving functions people want.
And a lot of that seems to revolve around their ATX LiDAR. What's the deal with the ATX? Why is it so important?
The ATX is really their strategic play for the mass market. It's designed to be affordable, ultra-compact, but still offer, best-in-class performance for its price.
So making intelligent driving more accessible.
That's the goal. Democratizing it, bringing LiDAR beyond just the super high-end luxury cars.
And is it working? Are OEMs adopting it?
Oh, yeah. It's already secured design wins with 12 major OEMs.
12 majors, okay.
They mentioned specific examples, like Auto using the ATL variant, which is closely related as standard across its entire L-Series EV lineup.
Standard equipment, that's key.
Right. And Zur also has a big win, putting ATX across several models and making it standard on their Zeekr 007 GT luxury sedan. Plus, they're expanding with giants like Great Wall Motors, Chery's iCar brand, and GAs for upcoming mass market vehicles.
Design wins are great, but Q1 was the start of mass production for ATX, right? How many did they actually ship?
That's the crucial transition. Yes, ATX entered mass production in Q1, and they shipped nearly 40,000 units just in that first quarter.
40,000 units in the first quarter out the gate.
Exactly. And it's powering cars like the Leapmotor's B10. That one's interesting because it's among the first to offer advanced ADAS with LiDAR at a pretty competitive price point, around RMB 120,000.
And the market reaction to that Leap B10 model, I remember reading something about the initial orders.
It was strong, really strong. They got over 15,000 orders in the first hour it was available.
15,000 in an hour.
Yep. And crucially, over 70% of those buyers chose the version with the LiDAR system.
70% take rate. At that price point, that says a lot about consumer demand.
It really does. It's a powerful signal that mainstream buyers see the value and are willing to opt for it.
Wow. And building on that, didn't they announce a huge follow-on order from Leap?
They did, a landmark order, they called it. 200,000 units of the ATX LiDAR specifically for Leapmotor.
200,000.
Yeah, set to go into a range of their production models starting this year, going into 2025. That's a massive commitment from a key customer. Shows real confidence.
Okay, so the ADS story in China is clearly heating up fast. What about outside China? Any progress internationally?
Definitely making moves there, too. They highlighted that exclusive design win they have with a top European OEM. That's a multi-year program, expected to run well into the next decade, covering both combustion engine and EV models.
That's a big one. Anything else?
Yeah, they specifically mentioned momentum in Japan. They just secured a new proof of concept, a POC development project with a top 5 global tier 1 supplier that's headquartered there.
Getting a POC with a major Japanese tier 1, that sounds like a pretty significant stamp of approval.
It really is. Japan is a tough market to crack. Overall, they said they're actively driving 5 POC programs right now with 4 top global OEMs and tier 1s across Europe and Japan.
And making progress on those.
Yep. 3 of those 5 POCs were successfully completed just in Q1. Now, POCs are just the start, part of that long automotive validation cycle, but completing them successfully puts them in a much better position for potential future contracts.
Right, steps along the path. Now, speaking of the future, they launched a big new platform recently, Infinity or Qingying. What's the significance of that?
Yeah, Infinity is a pretty big deal strategically. It's basically a platform designed to cater to the whole spectrum of autonomy needs, L2, L3, L4, but with a unified architecture.
Okay. And new sensors came with it.
Right, 3 next-gen automotive-grade sensors. The AT1440, the ETX, and the ATS. And
the platform kind of bundles these for different levels.
Exactly. They outline 3 main setups. Infinity IA is for high-level L4 autonomous systems. Think 4 of the AT1440 main LiDARs plus 4 solid-state FTX sensors for blind spots, giving you true 360 coverage.
Okay, that's the full L4 setup. What about L3?
For L3, which is conditional autonomy, they have Infinity IB that uses one of the new ETX main LiDARs, and they claim this has the world's longest range for automotive LiDAR, 400 meters at 10% reflectivity.
400 meters, wow.
And that's paired with 2 FTX sensors for the blind spots.
And then for the more common L2 ADS stuff?
That's Infinity IC. It uses one compact ATS main LiDAR, still powerful, but tailored for L2.
A key selling point seemed to be the shared architecture across these. What's the benefit there?
Huge benefit. They said there's over 85% component commonality between the AT and FT series sensors used in these platforms.
Okay.
For Hesai, and importantly for their OEM customers, that means faster development, lower manufacturing costs through shared parts and processes, and just much easier scalability across different vehicle models and autonomy levels.
Makes sense. Have these new Infinity Eye solutions gained any traction yet? Design wins.
Yes, they stated these new solutions have already helped secure design wins for over 120 vehicle models.
120 models.
Across 23 OEMs worldwide. They also confirmed all 3 main sensors, the high-performance AT1440 and ETX, and the more cost-effective ATX ODS, are suitable for everything from L2 up to L4, and crucially, have secured a series production design wins already.
And pricing, did they give any indication there?
They did. The AT1440 and ETX, being high performance, are priced above $500. The ATX aimed at volume is around the $200 mark.
Got it. Okay, that covers the passenger car side pretty well. But you mentioned robotics earlier as another key area.
Absolutely. The broader robotics market is just a massive opportunity. And LiDAR is fundamental, right? Every moving robot needs that 3D sensing capability. Yeah. Goldman Sachs, for instance, has some pretty eye-popping estimates for just the autonomous mobility market in China. Think robotaxis, delivery bots growing from maybe US $54 million this year to potentially US $47 billion by 2035.
47 billion, huge potential. And Hesai is already strong in robotaxis.
Dominant, as we mentioned. World's largest LiDAR supplier for robotaxis, they estimate they have 60-70% market share globally.
Wow.
Powering fleets from all the big names you know. Baidu Apollo, Didi, Pony.ai, WeRide.
Now, there's an interesting shift happening within the China robotaxi market specifically, right? Regarding the type of LiDAR used.
Yeah, this is really interesting. Chinese robotaxi companies are increasingly adopting ATX LiDAR, like Hesai's ET series, instead of the traditional, bulky, expensive, mechanical spinning LiDAR.
What about the switch?
It's all about scale and cost. The AT series offers the performance they need, but at a much lower cost point, and with better scalability for mass deployment. It helps them grow their fleets faster and gets them closer to actually making money.
So potentially much bigger orders for the AT series from that segment.
That's the expectation, yes. Significantly larger orders.
But globally, it's different. Global robotaxi players still use the spinning ones.
Generally, yes. Many global players still prefer the, let's say, sophistication of mechanical spinning LiDARs, like Hesai's own Panda series, for top-tier performance.
Yeah.
And Hesai is actually the exclusive supplier to one of the top global robotaxi companies that's scaling up its fleet significantly this year using that Panda series.
So they're playing both sides of that trend, effectively.
Exactly. Capturing demand, whether it's for the scalable ADS type or the high-end mechanical type, depending on the customer and market.
But it's not just transport, right? Logistics, consumer robots.
Right. They're pushing into L4 autonomy for logistics, too. Mentioned deals with Carabots for L4 robot trucks using their AT1440 sensor, and work with Zeekr and Neo on L4 delivery vehicles. And then there's the other robotics stuff. Their GT LiDAR was picked for robotic lawnmowers, which is a potentially huge volume market. And they expanded a partnership with a smart home robotics company in China. They expect to ship 300,000 GT units just for that customer over the next 12 months for consumer products.
300,000 units for smart home bots. That's real volume outside automotive.
It is. It reinforces their whole thesis.
Yeah.
Basically, every robot needs LiDAR.
Okay, one more key piece of news before we dive into the financials and investor context. The IP litigation, that seems like a big cloud lifted.
Huge. Yeah, the patent infringement case that Oster brought against them in the U.S. District Court in Delaware, officially dismissed in early May.
And the terms were favorable?
Extremely favorable. No conditions attached, no money changing hands, no injunctions. Just dismissed. A clean win for Hesai.
What does that mean for them strategically and for investors?
Well, management framed it as the end of all the current IP battles against them. They said it reaffirms their tech integrity, validates their IP, and underscores their R&D strength. For investors, it just removes a major uncertainty, a significant overhang that was definitely weighing on sentiment.
Okay, good context. Let's pull this all together now from an investor perspective. Recap the Q1 financials and then look at the outlook.
Right, so Q1, strong 46% revenue growth, fueled by those nearly 200,000 shipments. Healthy 42% gross margin, and importantly, OpEx down 9% quarter over quarter.
Which helped drive that big net loss reduction?
Exactly, down 84% year over year and hitting non-GAAP profitability. Management was quick to point out this was way better than their earlier guidance, especially for a seasonally weaker Q1.
Okay, so strong Q1. What about the guidance for Q2?
For Q2 2025, they're guiding net revenue between RMB 680 million and RMB 720 million. That's about US $93.7 million to US $99.2 million.
And the year-over-year growth on that?
Still very strong. Represents 48% to 57% growth compared to Q2 last year.
And shipments. Are they expecting another big step up?
Massive step up. Guided at over 300,000 units for Q2.
Over 300,000.
Which is almost a 250% increase year over year. They did add a note of caution, saying this guidance conservatively factors in the current tariff situation and some expected short-term shifts in demand, mostly U.S. robotics stuff pushing into Q3.
Okay, so even with that caution, are they still aiming for profitability soon?
Yes. They expect to hit GAAP break-even in Q2 right now.
GAAP break-even in Q2. That's a big target.
It is. And they also said they remain firmly on track for their full-year profitability goals, even while navigating these tariff headwinds.
Did they reiterate that full-year 2025 guidance then?
They did, unchanged. Revenue still targeted between RMB 3 and 3.5 billion. Total shipments 1.2 to 1.5 million units. Gross margin around 40%. And GAAP net profits of RMB 200 to 350 million for the full year.
Holding that guidance steady despite everything is definitely a statement of confidence.
It really is.
Now, let's talk ASP, average selling price. With the cheaper ATX ramping up massively, how does that impact the overall ASP and the margins? Investors always watch this closely.
Yeah, it's a super important dynamic. The blended ASP, the average across all products, will come down naturally as that lower priced ATX becomes a bigger slice of the pie. That's just math.
Right.
But they really emphasize looking at the ASP and volume trends for each product line individually.
Okay, so can you break down those product-specific ASPs and volumes for 2025?
Sure. So the older ATP sensor, that's around $350, but volumes are pretty low six figures, and it phases out late this year anyway.
Okay.
The high-performance AT series for L3 systems, that's around $500, smaller volume in 2025, but that's expected to ramp up significantly starting in 2026.
Got it. And the big one, the ATX.
ATX is the volume driver, market price around $200. Expected volume in the high six-digit range, maybe even up to 1 million units in 2025. They did mention modest discounts for those really large volume orders like the LEAP one.
So the blend comes down because the highest volume product is the cheapest, but they don't see prices collapsing across the board.
Exactly. They argued the ASP decline is predictable. It's driven by design choices like using their own ASICs and just basic economies of scale as volume ramps, especially on ATX and ATL. They explicitly said, don't expect some dramatic 50% price cut. The product architecture doesn't really allow for that kind of aggressive cost down while maintaining the performance and quality OEMs demand.
Makes sense. How does that feed into gross margin then? Lower ASP usually means fewer gross profit dollars per unit, right?
That's where the concept of LiDAR content per vehicle comes in. Even if the average price per sensor drifts down, they believe the total dollar value of LiDAR on each equipped vehicle will stay relatively stable long-term, probably in that $500 to $1,000 range.
How so?
Because as you move towards L3 autonomy, you often need multiple LiDAR units per car for that full 360-degree coverage.
Yeah.
So maybe you have one main forward-facing LiDAR and a couple of smaller side or rear units. That increases the total spend per vehicle, offsetting the lower price of any single sensor.
Ah, okay. More sensors per car.
Right. So they're aiming for a healthy and, importantly, relatively stable gross margin target overall. They pointed to their historical performance as evidence they can manage this mix shift without margins fluctuating wildly.
Okay, to deliver those million-plus units this year, they need capacity. What's the latest on their production expansion?
Domestically, in China, they said they're on track for about 2 million units of annual capacity by the end of this year, 2025.
2 million units?
Yep. New lines started construction in Q1, should be in mass production by Q3. More lines are already being planned. They highlighted how quickly they can set up new lines in China, like 4 to 5 months. Very efficient.
And what about overseas? That seems increasingly important given, geopolitics.
Definitely a key part of their strategy for long-term resilience and risk management. They just signed a lease in May for a new factory overseas in Southeast Asia.
Okay, location confirmed. Timeline.
Plan is to break ground later this year, 2025, and have it up and running late 2026 or early 2027. This will be specifically to serve their overseas customers. They also mentioned their highly automated production tech makes setting up overseas relatively capital efficient.
And what's the total CapEx forecast for 2025 with all this expansion?
Expected to be in the range of US 30 to 50 million for the full year. Pretty manageable.
You mentioned OpEx came down in Q1. What's the plan for operating efficiency going forward? Are they expecting more savings?
Yeah, they're targeting RMB 100 million in GAAP OpEx savings for the full year 2025 compared to last year. That 9% sequential decline in Q1 put them on track, or maybe even slightly ahead, for that annual goal.
And how are they achieving that while scaling revenue so fast? Operating leverage.
That's the idea. They talked about having this large, efficient mid-platform structure combined with a lean front end. Basically, it lets the business scale revenue and shipments dramatically without needing a proportional increase in R&D spending, for example.
So R&D costs stay relatively flat.
In absolute dollar terms, yes, expected to remain relatively stable, which means as revenue grows, R&D as a percentage of revenue should fall nicely. That's operating leverage in action.
Let's talk competition. It's a hot space. How did they address the competitive landscape on the call?
They tackled it directly during the Q&A, acknowledged, yes, the LiDAR industry is competitive, but they drew a distinction, saying very few players actually have proven mass production capabilities at scale like they do.
And where do they see their main competitive advantages?
They point to product performance, overall quality, and importantly, reliability, which is huge for automotive. They also mentioned quite pointedly that they're seeing a trend of ADAS customers actually switching to a Hesai from competitors.
Oh, interesting. Customer churn towards them.
Yeah, they see that as strong validation. They also cautioned investors to distinguish between companies winning a contract on paper versus those actually delivering in mass production and generating real revenue.
Right. Big difference.
And they stressed they focus on working strategically with high-quality OEMs at reasonable prices to ensure their own financial health, not just chasing volume at any cost. They also highlighted how sticky customers can be once integrated. It's hard for a second supplier to just swap in due to data compatibility, vehicle design constraints, etc. Their advice was, look at official OEM announcements, not just market rumors.
Good point. Now, the elephant in the room for many China-based tech companies recently, tariffs. How much impact are they expecting?
They addressed this thoroughly, said they're watching it closely, have done their analysis, and believe the potential impact is actually quite limited.
Why limited? What are the reasons?
3 main ones. First, their direct exposure to the U.S. market is relatively small, only about 10% of their total revenue expected in 2025.
Okay, 10%.
Second, within that U.S. revenue, only about half, so maybe 5% of their total revenue, is sold under DDP terms, delivered duty paid, where Hesai actually eats the tariff cost.
Got it. So limited direct cost bearing?
Right. And third, they feel their operational efficiency, their cost controls, and their strong market position give them flexibility to manage it. They have levers they can pull, like pricing adjustments or finding more internal efficiencies if needed.
And crucially, did they factor tariffs into their guidance?
Yes. This is key. They said a 45% tariff rate was already assumed in their base case scenario when they gave their full-year profitability guidance back in March.
So it's baked in already.
Pretty much. They acknowledged some customer behavior shifts, some front-loading orders, some maybe rescheduling, which is why Q2 guidance has a bit of a wider range and accounts for some shifts to Q3. But importantly, no major customer cancellations due to tariffs.
And the bottom line impact for the full year?
They expect the current tariff impact on their full-year gross margin and profitability to be immaterial based on their current analysis and assumptions.
Okay, that's clear. One last potential driver they discussed. Regulatory tailwinds around AEBS, automatic emergency braking systems.
Yeah, this could be a really significant accelerator. Historically, LiDAR might have been seen as optional for some AD's features.
Right.
But new draft regulations for AEBS are changing that. The idea is AEB should work automatically, like an invisible airbag, to prevent or lessen crashes, regardless of what the driver's doing.
And that requires better sensing.
Exactly.
Yeah.
To meet the performance requirements for AEBS in complex scenarios, think pedestrians, cyclists, tricky lighting, you really need advanced detection. LiDAR is increasingly seen as critical for that.
So how does that impact the market adoption of LiDAR?
It speeds it up dramatically. OEMs are now apparently rushing to get to 100% LiDAR take rates on more models because the regulators are pushing for this higher level of AEB performance. It makes LiDAR less of a feature and more of a core safety system requirement.
Interesting. So regulation itself is becoming a major demand driver.
It seems so. They mentioned discussions happening at the regulatory level are really emphasizing the need for advanced detection. And LiDAR is viewed as the key enabler. That's feeding directly into the faster penetration rates and why OEMs are marketing LiDAR capabilities so heavily now.
Okay, fascinating context. Let's switch gears now for our final segment. And just to be crystal clear, this part is purely speculative, okay? For illustration only, absolutely not financial advice.
Got the disclaimer loud and clear, speculation hats on.
Right. So based on everything we've unpacked from this Hesai Q1 call, let's imagine we're hedge fund analysts. We have to pitch a couple of outrageous but plausible trade ideas to the investment committee. Idea number 1.
Okay, pitch idea 1. Let's call it the mass production momentum long.
Okay, the thesis.
The thesis is simple. The market is still way behind the curve in appreciating just how real and how fast Hesai is converting design wins into actual, profitable, high-volume shipments.
And the evidence from the call.
You've got confirmed ATX mass production start in Q1. Nearly 40K units shipped first quarter out. Q2 guidance pointing to over 300,000 total shipments. That landmark 200,000 unit ATX order from Leapmotor locked in. And critically, they reiterated that full-year GAAP profitability target, even after accounting for tariffs. Plus, the IP cloud is gone.
So the argument is the execution risk is dropping rapidly.
Precisely. You've got confirmed operational execution, massive scaling happening right now, and a clear line of sight to GAAP profitability, maybe even starting this quarter. That combination of tangible growth and financial discipline is rare in this space.
And the outrageous part of the pitch.
The outrageous part is the conviction level. You argue this isn't just incremental improvement, it's a fundamental shift. Pitch a heavily overweight long position, maybe significantly larger than typical for a company this size or relative to peers. The bet is that hitting GAAP profit in Q2 and delivering on that full year number triggers a major re-rating. The narrative shifts from speculative LiDAR play to profitable scaling market leader justifying serious multiple expansion.
Okay, that's definitely a high conviction long. Pitch idea two.
Idea two, the IP and scale advantage, paired trade.
Paired trade. Long one, short another.
Exactly. The thesis here is that Hesai's structural advantages, their validated IP, their proven mass production scale, their improving financials, and customer stickiness are creating a widening gap between them and the smaller, less established competitors.
So capitalizing on divergence.
Right. Hesai has the #1 market share rankings. They just decisively won their IP fight. They're hitting non-GAAP profit now, guiding to GAAP profit imminently. They're executing the production ramp. Management even hinted customers are switching to them.
And the other side of the pair.
You short a smaller, publicly traded competitor, someone who is likely still burning cash, struggling to scale efficiently, potentially facing pricing pressure, trying to win deals against Hesai's cost structure, and maybe hasn't cleared their own IP hurdles.
The argument being Hesai pulls away.
The argument is Hesai's advantages become increasingly apparent and insurmountable for some weaker players, especially as the market matures and demands scale, reliability, and cost effectiveness. Hesai stock should outperform, while the weaker competitor stock underperforms or even declines.
And the outrageous part here.
The outrageous part could be getting quite specific about which competitor to short. Targeting a player that looks particularly vulnerable based on their financials, reported design wins versus actual shipments, or technology roadmap compared to Hesai's new Infinity Eye platform. It's a bet on accelerating divergence and potential consolidation or failure among the laggards.
Okay, again, purely illustrative, definitely not advice, but those scenarios really crystallize some potential implications from the call.
Exactly. They force you to think about what the key takeaways really mean in terms of potential market direction and company performance.
So let's quickly recap the core points from our deep dive into the Hesai Group Q1 2025 earnings call. What stood out?
Well, first, really strong Q1 performance across the board. Revenue, shipments, margin, and that big jump towards profitability.
Clear progress towards hitting GAAP profitability, maybe as soon as this quarter, and reaffirming the full year target.
Confirmed market leadership across automotive, passenger car, and especially robotaxis, backed by those EO intelligence numbers.
Validation through tons of design wins, plus that huge landmark order from Leapmotor for the ATX.
Tangible progress on expanding internationally, particularly cracking into Europe and Japan with key OEMs and Tier 1s.
The launch of that new Infinity Eye platform looks designed for scalability and addressing L2 through L4 efficiently.
Successfully putting the IP litigation behind them, which removes a major overhang.
And finally, a clear analysis and plan for managing the tariff situation, which they currently expect to have an immaterial impact on their full-year goals.
It was a pretty packed call with a lot of positive indicators, balanced with realistic acknowledgments of things like tariffs.
Absolutely. Now, just remember, everything we discussed today is based on forward-looking statements made by the company during their call. Investing always carries inherent risks.
And let us reiterate one last time. This conversation, and especially those speculative trade ideas, are strictly for informational purposes. They do not constitute financial advice in any way.
Please, always conduct your own thorough due diligence. Analyze the LiDAR market, look at Hesai Group specifically, consider the competitive dynamics, think about how fast this technology is moving from, a niche gadget to potentially a standard piece of safety equipment, and what that really means for the companies involved.